Hey, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. You are tuned into our YouTube channel for our weekly video analysis. If you like this video, please give us a thumbs up and consider subscribing. So we're going to start off with setting your bias based on the bigger trend in the market regime, because that's the most important thing. We'll look at the market regime, we'll look at yield spreads, and we'll look at the trend in SPY. And then we're going to go through the 5 big offensive sectors because they are also in downtrends, and that supports the bear market thesis. So when trading or investing stocks or stock-based ETFs, it's important that we have a bias, a broad market bias and a trend bias. Now, this bias isn't something that you get from reading the news. That's where you get the wrong biases probably. This bias comes from analysis of the trend. Are we in a long-term downtrend? That gives you a bearish bias. And are we in a bull market or a bear market? And right now, I think the long-term trend is down for SPY. That's a bearish bias. And I think the market regime is bearish. And so I just want to review the market regime first, and then we'll look at the trend in SPY. So this is the main page at TrendInvestorPro.com. And I'm going to go to the analysis page here. And this is where I post all the recent commentary for this website here, my website. And I've got a page up there, the market regime page. And that is where I keep track of whether we're in a bull market or a bear market. And so I'm on this page now, and at the very top, I will put my composite breadth model, which kind of dictates my stance for the broader market. And we can see that that model is in the middle window there, and it's currently at -5. So that means all 5 inputs are bearish. And it's been bearish since April 11th. And if you look up at the top, you can see that that is when the red arrow is when it turned bearish. We had some whipsaws earlier in the year, but whipsaws are going to happen. But right now, the composite breadth model is negative. And then if we look down in the the middle indicator window, we can see the 5-day moving average is around 7% below the 200-day moving average for the S&P 500. That's a downtrend. And then we look at the percentage of S&P 500 stocks above the 200-day. Less than 40% are above the 200-day. That's also a bear market condition. So all 3 of these are pointing to a bear market condition. So this is basically the first step in the market regime. And then the second step is I do look at yield spreads. Now I look at stock-related information first and foremost. And yield spreads, bond market, the dollar, gold, all that stuff is secondary. But yield spreads, I think, are important because they show what is happening in the credit markets. Do we have signs of stress in the credit market or signs of confidence in the credit market? And the way we measure that is with the spread between a corporate bond and a treasury bond. So the treasury bond is the safest asset out there. So say the treasury bond is yielding 3%, the 10-year. And then you have a corporate bond, and say that corporate bond is yielding 5%. Well, that spread is 2%. And the more that spread grows, the more stress you're seeing in the credit market, because that means that bond investors are demanding more premium over treasuries, and that's why that spread widens, and that's why that shows stress. But as the bond market has confidence, that spread narrows. And so you can see here in this bottom chart here, this is the triple B spread. And it's basically the difference between triple B corporate bond yields and treasury bonds. And there's an ETF for triple Bs, MBBB. But we can see, from March 2021 until January 2022, this was below 1.3% roughly. It was low and flat, showing no signs of stress. But then in January, February, we got this big widening. And that showed stress in the credit markets. And you also notice, if you look up top, you see SPY fell and yield spreads widened. Then you see SPY bounced in March and yield spreads narrowed. And then we can see SPY fell in April into mid-May, and the triple B spread widened considerably. And then we get this bounce in SPY in late May, and we can see the triple B spread narrowed. Now, there's a lot of ebb and flow here, and maybe there's a wealth effect working with the S&P 500 because stocks rise. That increases confidence. That's positive for the economy and for stress levels, puts more confidence in the bond market. But despite this wealth effect, if you look at the overall trajectory here for the triple B spread, it's elevated and it's rising, it's widening. And that is a net negative. That shows more stress than confidence in the bond market. So sure, we have the ebb and the flow, but the overall trajectory is a widening and more stress in the credit markets. And I think that is negative for stocks. And that's part of the reason why I am in a current bear market stance. So the market regime is the first step. The second step is what is the overall trend for the ETF you're looking at? Now, pretty much all stock-related ETFs have some sort of headwind because we're in a bear market. And if we look at SPY here, it's clearly in a downtrend. You see these red channel lines. They mark a series of lower highs and lower lows, and that is the basic definition of a downtrend. And you can see during this downtrend, which started basically in January, we had a 6% surge and a lower low. We had a 10.7% surge, and then we fell sharply. So we went in excess on the upside, and we went in excess on the downside. We got below that lower channel line, and we're oversold. And we got a 6.6% bounce in 5 days. And now SPY is kind of consolidating. Now you might say, well, this looks like a potential bull flag or a pennant. And yeah, technically it is because you got a surge and a consolidation, and a breakout there would be bullish. But it comes down to what is your trading bias. My trading bias is negative. It's because we're in a bear market and we expect bearish outcomes are more likely than bullish outcomes. So that's why I'm not interested in a pennant here. I'm not interested in bullish patterns. I'm more interested in the fact that we're at a potential resistance reversal zone. So even if we break out here, I expect resistance in the 420, 430 area. So I call this a resistance reversal zone is because there are a number of items coming together that either mark resistance or increase the odds of a reversal. First of all, you have broken support, which turns into resistance. Second, you have the May highs here, early May highs, which mark resistance. And third, you've got a 50 to 67% retracement zone. So a normal counter trend bounce after this big decline would be expected to retrace 50 to 67%. And so you combine the resistance and the broken support, you've got a resistance reversal zone in this 420 to 430, 35 area. Now, we can't get pinpoint exact levels on this because we are guesstimating, if you will. But if we break support here, this little low, I would expect at least a test of these May lows because the bigger trend is down and we are in a bear market. So I was going through these sector charts and looking at the trend composite and the overall trends, and 9 of the 11 sectors are in downtrends. Only 2 are in uptrends. I'm sure you can guess which ones those are. One of them has a big E in it, energy, XLE. The other one is utilities, XLU. But the other 9 are in downtrends. So I've got XLK here with the trend composite in the indicator window, and that's part of the TIP Indicator Edge plugin. And if you click on that plugin link in the bottom right, there you can see all the available plugins, and there is the plugin, and you can click that link to learn more. And over on the left here, up at the top, I'm going to open up the chart settings, and there you can see all the indicators. There's 11 indicators that are part of this plugin. So if we look at this overall trend for XLK, clearly in a downtrend. And just like SPY, it became oversold there in May and got a bounce. And just like SPY, you can kind of see support turning into resistance. You've got the May highs here marking resistance. You don't even need to put on your Fibonacci retracements because you can see this is a decline and this is about 50%. So this is a zone where I'd expect resistance or a reversal, and we're at the very bottom of it. And so this is kind of it's not a make or break level. Even if we break out here, we're still in a downtrend overall, and my bearish is still biased. And then if we look at the other sectors, that's XLK. If we look at XLY, we can see a similar pattern here. Look at that big decline, very oversold, getting a bounce, but not even back to broken support. So one of the weaker bounces and one of the stronger downtrends out there. If we look at XLC, which is communication services, you can see that it's in a very strong downtrend, 52-week lows. And when I talk about your bias, if you're making a big move off of a 52-week low, it's a counter trend bounce until that trend reverses. So you can see here we have a 52-week low in December and we have a bounce. We have a 52-week low in January, and look at the size of that bounce. Counter trend bounce still. We had a 52-week low in March, and we get a bounce. Sorry, I don't know. I'm not sure if those are 52-week lows. I have to. Those are not 52-week lows, but we're getting 52-week lows here in 2021, 2022 there. So I'm going to open this back up. But the point is, you get a 52-week low, and you get a big bounce. Well, it didn't even come close to making a higher high. You get a 52-week low and you get a bounce. It's a counter trend bounce. You still got to keep that bearish bias. Don't go, I'm not out to pick bottoms, basically. I'm going to let that first move, that first trend changing move go, because I think the odds favor a direction, a continuation in the direction of the bigger trend, which is down. And when we're in a bear market, I think you're more likely to have bearish outcomes than bullish outcomes. If we look at XLF, another one of the big sectors, we can see a breakdown there and a bounce, but coming back to broken support that turns resistance. So yeah, short term, you got a surge and a potential pennant, and a short-term breakout would be bullish, but I'm not biting. I'm not hearing this short-term siren song, if you will, because the bigger trend is down and we're in a bear market. And then if I look at XLI, we can see a similar situation, a lot of support there that was broken, and we haven't come into that level, but we've come into the first reversal zone, because you can see we've had a sharp decline and we bounced and we're coming back. You have a support term resistance. So XLI is already hitting its potential resistance reversal zone. So these are the big sectors. They're in downtrends, and that supports the bearish thesis. So if you'd like to know more about trendinvestorpro.com, you can click on the link in the description below. If you like this video, please give us a thumbs up and consider subscribing. Thanks again for tuning in, and I'll talk to you again next week. Have a great day.